Hi there and welcome to the Stock Club podcast, coming to you from the top floor of MyWallSt HQ here in Dublin, Ireland. In this week's episode, we're going to talk about how automation could be the big winner for Tesla, the stock we're most excited about that isn't in the MyWallSt app at the moment, and the IPO our analysts are most looking forward to in 2019. So we're going to kick it off this week with some of the news stories that caught our eye over the past fortnight. Maeve, what's happening over Twitter?
Something is happening with Twitter where they're testing hiding replies.
Okay.
In an effort to combat breach of policy on the platform.
Yeah.
So I'm going to admit something. I'm not able to watch or listen to the Joe Rogan podcast. I don't know if anyone else in this room is, but we'll leave it impartial. But a friend of mine heavily recommended that I had a look at one that was broadcast 2 days ago because Jack Dorsey was on it.
Yeah.
And he was joined by one of, I think, the most senior legal people in Twitter. Vidya Gadid is her name, or Vidya Gade, I think is how you pronounce it. And they were getting grilled by Joe Rogan and another lad about Twitter and what happens when someone breaches a policy. So what happens when there's harassment or threats. I think one of the main talking points was there's a very popular news and entertainment website, which I won't name, in the States, who laid a lot of their journalists off recently.
Oh.
And what happened was...
Why can't you name it?
Just staying safe.
Let's all try and guess.
Future-proof.
Yeah. We haven't been sued yet. Let's keep going.
What happened was basically people lost their jobs and there was one or two high-profile individuals and they got like tons and tons of tweets with a meme saying learn how to code. So wasn't it the most empathic way to react to someone being laid off?
Yeah.
But it gets worse than that. Like it gets towards kind of death threats and kind of ugly harassment. And we all know that Twitter can be a bit of a troll-like landscape. So basically what I think Twitter are doing are, instead of kind of going really heavy, which they have done, and kind of deplatforming people and looking like the bad guys, they're going to test this feature that lets you hide people's replies.
Yeah. So it's nearly a balance between the people who cry free speech when they're taken off Twitter and then obviously the horrible stuff we see on Twitter.
That's how I think Twitter are positioning it, and I think like lots of people who would be part of the clamorous noise on the platform see it the way you just phrased.
Yeah.
So I think they see it as a fairer tactic.
Yeah.
I'm not sure.
Yeah. Do we think maybe is it going far enough? Twitter's kind of eternal problem has been just the kind of, it's a bit of a wild west sometimes in terms of the things people say and the abuse that's thrown around. Does it go far enough, I wonder, for Twitter?
This just seems to be the constant question that we seem to face every time we sit in here, which is how do you police a platform where all the content is user generated?
Yeah.
I don't know, does that hiding replies? I mean, you still know they're there. So you could just not look at your replies if you wanted to.
Yeah, trolldom was introduced, I guess, by the internet and has allowed a lot of people to anonymously say whatever they wish. And as you say, Roy, these platforms are struggling. They're all struggling on that balance between leaving it fair and open for anyone to voice an opinion with the nasty stuff that inevitably bubbles up. In fact, we've even seen it in some of correspondences that are anonymous into us, through customer support platform.
Yeah, people really go in for it on the internet. You know? So I mean, Rory, you're right. How do you really police it in a rigorous way? We keep talking about governance in most podcasts now, and it is me that brings it up, but it's fascinating,
It is,
because like the internet is an unstoppable force, and there are people out there who I think get quite nasty, and it can affect people's lives. So how much do we need to care about it, and what do we do?
Yeah, I mean, there's like a saying which is like, give a man a mask and you'll see his true self. I actually think on the internet it's even worse. It's like you give someone an anonymity and they actually become the worst version of themselves. Like it's not, they're not just themselves. They're just like, because they're so anonymous, they think they can just say anything and get away with it and no one's ever going to know. Which is probably true, but why do it?
Yeah.
Given the recent problems, though, that other platforms like YouTube most recently have had with kind of this type of content going onto their site, and like the impact it has on advertising revenue, which is the majority of Twitter's revenue, it's going to be really important to see how kind of clampdowns like this affect the platform.
Yeah.
And the stock.
And the stock.
Yes, absolutely.
There was a kind of news story kicking around a few years ago, a rumour anyway, at least, that Disney was looking at buying Twitter.
Oh yeah.
And Bob Iger actually said they did look at it for a while. But the problem was they were like, Disney never wanted to put its name beside something that had all these problems in it and the kind of content that was being generated on it.
Yeah.
So I think with that in mind, Twitter have taken a lot of steps to try and cull out a lot of it. I know Dorsey did a tweet interview with Kara Swisher a few weeks ago, and she really took him to town on it. And he did point out a lot of the things that they are trying to do. But
trying being the operative word, though, isn't it?
it's a really hard thing to do, though.
I know, but it's like we're seeking to.
Where would you go with it, though? How do you get that balance between allowing people to express themselves anonymously?
You can't control the horde.
Yeah. The problem is the anonymity of it all. Like, you think about it, freedom of speech, which is something we all value and cherish, and the ability to express oneself in whatever way they feel is appropriate, is fine. And it was the rudiments of that, that part of the Constitution is based on that the speaker will be known. The face of that person, or the writing hand of that person will be known. But now, the anonymity of it all has actually prevailed, and now people are, as you said, descending down to places lower than they would behave in a general polite society.
Yeah, I mean, it's typical of when you give people these rights, freedom of speech or the right to free speech, no one really focuses on the responsibilities that come along with it. There's loads of people in the world who don't have that right, and maybe people should just be a little more careful with it.
So moving on, Rory, I believe you've some news about Tesla that doesn't involve Elon Musk.
I know, this was brilliant. And this was a real eye-opener for me, because it was kind of the first time I realised in ages that we were talking about Tesla and it wasn't an Elon Musk related story. So actually this isn't a brand new story at all. It kind of emerged from a brand new story. So the news story was that Tesla's closing down all its dealerships. So you'll be buying totally online now. They reckon that they can cut the cost of the cars by about 6% by doing this. They'll still have these really nice galleries where you can go in and look at them and sit in them and you look at all the features, but you won't be able to test drive them. So, I mean, they're taking a big risk here on the fact that people will trust them to that they'll like the car that they're getting. I think they can send them back after a few days or 1,000 miles or something like that, so if they don't like them. But whatever about that story, this brought up another story, which was that there's analysts. She's the chief investment officer. Her name's Catherine Wood. She's chief investment officer for something called ARC ETFs, and they make ETFs that are totally focused on companies that disrupt.
Okay.
So the top 10 holdings she has in her ARC Innovations ETF are Tesla, Stratasys, which Emmet used to be a shareholder of, 3D printing company, Nvidia, Square, Twitter's in there. They have the Editas and CRISPR companies. So they're really into companies that are out doing kind of mad stuff and trying to change the way we do things. And their annual return over the past 3 years has been 24.82%, which is pretty good for an ETF. They have crushed the market.
Yeah.
Absolutely crushed. So Catherine Wood, obviously a very clever person. She was on CNBC and she's talking about Tesla, and she's put a $4,000 price target on it as a stock.
I saw that.
What's Tesla sitting at the minute?
It's about 270 as we speak.
Wow.
That's an increase of about 15-fold. And this is the best case scenario, she says. Or not, it's not even the best case. This is her bull case. Her bear case, which is the worst case scenario, is that the stock's $700. So that's still threefold your money. So yeah, I mean, look, people always, it's great to come up with these mad price targets. You always get on TV to talk about them.
Yeah.
But look, she's done very well in the past, and she's making the argument that currently Tesla is in a very low margin business, and that's making and selling cars. And we know it is a low margin business, but that in the future Tesla will be generating most of its profits from what she calls mobility as a service, or MaaS. So it's a new version of SaaS.
We needed a new one.
We need a new one. So she thinks Tesla in a couple of years will basically just be a massive fleet of autonomous taxis, and they'll be taking a cut of about 30% of every ride that you take.
Couldn't agree more.
Yeah.
Could not agree more. Tesla's my second biggest holding. It's a 10-bagger for me. I really hope she's right, because it'll be a 100-bagger for me.
150 bagger.
150-bagger, yeah. Sorry, my simple math is broken. And it sat around $20 for the longest of time, and I've followed this story from the early days, I think long before anybody it was on the broader radar of the world. And I certainly agree with that opinion that their great opportunity is, number one, the second car in the driveway, That's their competitor number one, and competitor two is the first car in the driveway. So, if there's a fleet of autonomous cars at that high spec level and a lovely app that accompanies it, I think whether it's Tesla that gets there or whether it's Uber or one of the other players, I think it is the way of the world that car ownership will ultimately go into decline.
The biggest risk, though, really, though, is regulation, then, isn't it? Because obviously an autonomous future, kind of, we seem to be hurtling that way, but cars aren't just going to arrive on the street all of a sudden with no drivers. It's a very much localized thing.
It's funny you said that, James, because I also saw a video this week. It was posted on Twitter.
Man on the highway.
Yeah, there was a guy. There was a video posted on Twitter, which was a guy in a Tesla. Like, this guy was driving along and he was videoing another guy in a Tesla at 75 miles per hour in the middle of the motorway, and he was sleeping.
Yes. Yeah. Oh,
which was deeply worrying.
Yes, deeply worrying.
I understand the premise here, guys. I get the concept, but I'm not on board.
So did he buy the Tesla so he could sleep, or did he sleep because he had a Tesla? But either way, it's wrong.
I mean, obviously this guy trusts it. He must have had a Tesla for a while and seen the autopilot work. He must trust it a lot to
it's
go
better
for
than when I'm awake.
And it was open mouth snoozing. So.
Oh yeah,
he was
out.
4 a.m. had started.
But I think the big thing about that, Rory, is that it's really moving the focus from Tesla. When people talk about Tesla, it's the electrical vehicle innovation they talk about primarily, and automation often comes second. But this kind of interview really puts the automation to the fore for Tesla, which is something we don't often see.
Yeah, I mean, and she is, I think, anticipating or assuming that Tesla is going to be the lead in autonomous vehicles, which I don't know if they are. They've got a lot of competition in that space. There's Google doing things, there's guys out of MIT doing things. Loads of people are trying to get into the autonomous vehicle game. So I think she's saying that they're going to be the number one, which they very well might be. But just on the point, she also, this $4,000 price target says it only includes the cars and taxi network.
Okay.
So it doesn't include profits from anything else Tesla's doing, and that's including their trucks, the drones, the energy storage, or even China. She's totally eliminated China out of this price target. So she says it's conservative. It doesn't sound conservative.
Yeah, well, here's hoping.
But anyway, it was just nice to listen to her interview and think about Tesla as a business for once, and not the business side of crazy Elon.
And not Elon. What did he do on Twitter? I know we're not trying to talk about Elon, but I saw a picture recently of his face on The Rock. Was it?
The Rock. Did he do that?
I don't think he did. I think someone sent it to him.
It's more spare time than I thought.
Sorry, mate. We have to get Elon in there somewhere.
Staying quiet this time.
Yeah.
So next up, we're going to move on to our company we never talk about. Emmet, it's your turn this week, and I believe you're going to talk about a company that's not in the MyWallSt app at the minute.
So not only do we not talk about it, we've never spoken about it, and the company I'm going to talk about is Stitch Fix, which is a US business that IPO'd in December 2017.
So do you want to just explain what Stitch Fix do a little bit first?
Absolutely. Well, to read from their website, the Stitch Fix experience is not merely curated, it's truly personalized to your taste, budget and lifestyle. Stylist handpick items for you. So what Stitch Fix actually does is it sells monthly subscription boxes full of fixes, which are personalized styled clothing for women, men and kids. And they go on to say that their personal stylists save you time and trouble of selecting clothing and accessories, and then they go on to say many of their clients enjoy the ease and convenience of automatically scheduled shipments that arrive at a frequency of their choosing. So Stitch Fix basically sells clothes in a box, shipped to your home. They have about 3 million subscribers to their service, and Stitch Fix is a stock that's been on our radar for the longest time, James, Rory and I, and we've discussed it for quite a time, and it's also a consistent favourite of our friends in the Motley Fool over in US of A. So we know that the Fool have lauded this stock from the earliest of days, and we take their analysis very seriously, and they're wonderful analysts over there.
Yeah.
The reason, however, that we were not with the Motley Fool in their belief was a concern that the three of us had around their claim that they have built a cutting-edge recommender system. So here at MyWallSt, we've been building a recommender system for several years, and no, it's easy to say you've done it, but it's very complex to do well.
Yeah.
So I think it was Rory who raised a point, which was like, and we debated that giants like Nordstrom could do the very same, and they have all the inventory and insights in the world, and can launch a clothing service by post. So we paused, you'll recall from our multiple conversations. However, in the last week, I had a meeting with Professor Barry Smith, who is from University College Dublin and is an advisor to MyWallSt and me personally over the last few years since I've co-founded a business with John, and Barry is one of the world's leading authorities on recommender systems.
Okay.
And has advised the biggest businesses and biggest names in the world on systems that exist in software we all use every day. He is an expert's expert, and to the point that he is like he testifies in court on expert witness cases in the US in recommender systems. He really, really knows it. And in the course of our conversation, which was about MyWallSt and how we're evolving our business here, I asked Barry who has built the most impressive recommender system in recent times. And who did he say? Out of the blue, unprompted, he said Stitch Fix.
Okay.
Which really arrested me because I didn't expect him to say that. And I think, you recall, James, the three of us have debated that, is the claim to having an awesome recommender system just something that you can just say and not actually have, or
a
little bit of bluster, or is it an Excel spreadsheet with some smart people walking up and down aisles, figuring out that Emmet only wears blue, or Rory doesn't like cardigans and this kind of stuff, so
how dare you.
So Barry elaborated and said, like, there's a Tinder-esque app that Stitch Fix has built, which has its users kind of lying in couches or riding on trains or whatever, swiping left on the clothes they dislike and right on the clothes they do like, and it's gathering up a vast amount of valuable data in a very short time, and it's quite an innovative way of using a tech that the world is used to on their smartphone. And people like their clothes, they like swiping, and they brought those two things together and built up a giant database of unpolluted data on the tastes of users, and have built something that I believe from our conversation is truly unique and very difficult to replicate. So our conversation continued, but by the end, let's just say I was a believer and believed so much I invested for the second time earlier this week with my own dollars. So Stitch Fix won't be the next stock in our next star stock. That's been chosen, and it's a wonderful business. I won't be unveiling it today. However, Stitch Fix is likely to follow soon. So I felt it was incongruous for me to buy a stock that isn't in our app, but and that's why I'm talking about it now. And I have never, well, at least in 10 years, ever bought a stock without declaring it on Twitter. And this is the declaration and the explanation as to why it's not the next stock into our showroom, and also why very quickly I became a believer. And I had to say, you know what, the guys at the Fool are right. The recommender algorithm built by Stitch Fix is a differentiator, and Jason Moser and Bill Mann and friends of ours from the Motley Fool said it long before we said it. But now, having spoken to our own expert in the area, a guy who really, really knows recommender systems, for him to just call on that business from cold, knocked me back, because he said this is truly impressive.
So it'll definitely remain on the shortlist for now.
It's going to remain on the shortlist for now.
Cool.
Rightio. Okay, so next up we have Jargon Buster, which is the part of the show where we ask our users to send in phrases or ways of explaining things in the industry that can be perceived as jargon, and we bust them. So we have one definite piece of jargon and then two other phrasings to kind of work through. So we have three things today. The first up is goodwill and impairment charges.
An exciting one.
A really exciting one.
Yeah. Rory.
Can I ask, is this the same as good faith?
No.
Oh, okay.
It's going to get exciting, mate. Hold on to your seat.
Rory has been waiting for so long for someone to ask him this question.
Yourself in.
He's trembling, look.
Goodwill is an item that appears on a company's balance sheet, usually it's in fact always as a non-current asset, and essentially is when a company acquires another company, they tend to pay a premium on that company. So let's say the company is worth 10 million and they ended up paying 13 million just to get the deal over the line. There's kind of 3 million quid that they've paid that they don't have anything to show for. So goodwill is kind of assumed worth that the company they acquired had, if that makes sense.
It does.
Yeah.
It's just to keep the balance sheet balanced, basically.
To keep the accountants happy.
Yeah. You can kind of look at it and go, oh, this is all the money you've wasted over the last 10 years buying companies. No, I mean, it takes in things like, is there going to be synergies and things like that can't really be quantified in dollar amounts. But yeah, it's an accountancy term.
Okay.
Impairment is, this probably came up because of the Kraft Heinz story that happened a few weeks ago, which is when a company has on their balance sheet intangible assets. So in Kraft Heinz's case, they'd valued the Kraft brand and the Oscar Mayer brand at multiple billions of dollars. And having looked at them over the years and seen how they're performing now, they're thinking those brands aren't quite as valuable as what they were before. So they've taken an impairment charge, which is a knockoff of the value that they thought they had there.
Okay.
Right.
Pretty clear to me.
Yeah, perfect. Okay. The next one we actually have sent to us by name. So Simon Dempsey, thanks for asking us to explain this. It's not exactly a phrase, but people do ask this a lot, which is there a pattern on the best time of day to trade? So is there a time of day to buy or sell that you should have kind of earmarked to go in?
Sure, I'll take that one. While there isn't a time you should buy, I think there's a time you should not buy and should not sell. And basically the first half hour of the trading day and the last half hour I generally would avoid, simply because larger amounts of money are flowing in and out of a lot of businesses at that time from orders that might have built up overnight. News that's been digested by the general public from last night will generally make its way in or out of a stock, first thing in the morning. And really, if you are going super long term and you just want to just buy at market rate, which is in the moment, avoiding Fridays as well, because again, money leaves the market on certain Fridays in the year. So if you're going to buy a stock and all things are equal, personally, I dodge the first half hour. I don't bother putting in a market order until after 10 a.m. EST, and same goes for sales.
And if you can help it, don't buy out of hours.
Oh, absolutely, unless you use a limit order. Yeah. So you're right, most full service brokers, in fact, almost all brokers will allow you to buy out of hours. And what's happening there is your order is lodging up on a big system waiting for the market to open. And in that very first few seconds where orders are fulfilling, prices can do wild and wonderful things. Not always, but so if you are putting out of hours order through your broker, to put a limit in there with it is prudent.
Right, okay. And we have another for this week. Another user called Damien O'Sullivan, cheers Damien, sent us this, which is basically one of our golden rules here in MyWallSt is to try and become a diversified investor. Yeah. So when you have a diversified portfolio, what next?
So the greatest investment minds all agree diversification is a very important aspect to get, to embed in your investment philosophy. There is no one answer as to how many is the right number of shares. There's some great fund managers who have beaten the market returns with as few as 12 stocks, and then there's others who have had thousands of stocks, like Peter Lynch of One Up on Wall Street fame. So the way I personally would describe it is you diversify to the point where I would, we all need kind of rough rules, but I would say most people should aim to have more than 12 stocks in their folio and keep going until they're comfortable. And I think what I mean by that is when you're going over 20, the more stocks you add to your folio, the more your portfolio is likely to match the average returns. So you might be better off just owning an ETF. So I would say somewhere between 12 and 20 stocks is probably a nice place for a retail investor like you and me. And when you've built up a portfolio that you're happy to keep an eye on these dozen stocks or so, add to your winners, add to the ones you like the most, and continue to add money regularly is the most important thing. But I say once you get over 12 shares, I personally generally I very rarely have owned more than 22 stocks at any one time. I've just learned through just living that that's just too many for me to follow with the level of detail that I like myself.
That's a big part of it as well too, is having some dry powder, having some money
Yeah,
ready for
it is.
when there's pullbacks
Absolutely.
and stocks you really like.
Yeah.
Being ready to go in straight away and add to your position.
Yeah, and dollar cost averaging is a strategy where you, at a fixed point every month or quarter,
Yeah.
add new money to a stock you already own.
Yeah.
And the math of it works out that over the long term, you're better off by doing that. So
Yeah.
I won't dive into that maths equation right now, but effectively adding a little often is better than adding a lot at the start.
Yeah.
Okay, great. That was Jargon Buster. Now we have elevator pitches. And this week I will be waving a stopwatch.
This
Emmet's back.
threat is thrown around week in, week out.
So it's a
Well,
long
you might
elevator.
notice that I'm more on the mic this week,
Yeah.
James.
Yeah,
Fields of
yes.
power.
And you're
So,
yeah, exactly, right.
right. So what's happening this week is we're talking about the most anticipated IPOs of the coming year. Do we have 2 or 3?
We've two.
We have 2. Okay. Emmet and Rory.
Uh-huh.
Right.
Yeah.
Who wants to go first?
How long have I got?
You've got 60 seconds
What?
from when my thumb hits this phone.
So who's going first?
You.
All right, okay.
1, 2, 3, go.
So I don't know if our B&B is actually going public, but I know they're aiming to go. I'd be ready to be public this year, and that was widely reported in TechCrunch and many other publications. So my family and I have been fans and users of Airbnb for the longest time, and I've stayed in about 20 Airbnbs around Europe and the US. My wife has stayed probably in as many as 40 or 50 hosts, and that's basically because she's worked with the company for about 5 years, which in the scheme of their timeline means she was one of their earlier employees. So a caveat is my household, specifically my wife, will be a beneficiary of their IPO, so I obviously wanted to succeed. My opinion on the business, and any business, is unbiased by my personal ownership, so I don't want them to succeed because they're a shareholder, but I really believe in the business, and the reason I totally believe in Airbnb is that its founders are wonderful, they're honest, they're driven. So Brian Chesky, Joe Gebbia and Nate, whose surname I can never pronounce, have created something utterly wonderful, culturally amazing, and it's one of my favourites. 60 seconds.
Boom. Very good.
So why exactly are you really anticipating this IPO, Emmet?
So I mean, like, can I keep going now that the time is up?
Okay, Rory.
Well, hold on, just before you start, that was one I wanted to do. So I had to choose another one, but
Drops the mic.
yeah, no, that is the one I'm very excited about. But I'll talk about another one.
Okay.
And they haven't actually said we are.
No, they
definitely
haven't,
gonna do- but
it's
it's widely reported that they're
Yeah.
getting ready.
Yeah. So I'm going to be really boring and go for the one that everyone's expecting, which is Uber. So the reason I'm picking Uber is not because I particularly think it's going to be a good investment, but I do think Uber are one of the few truly disruptive companies in the world. Loads of companies claim that they're disruptors. Uber actually has changed the way we live in a massive, massive way. And in many ways, I think we needed a company like Uber to get this far. I think a lot of companies or a lot of businessmen would have done something similar to Uber, gotten into the legal mess of things and gone, okay, we need to back down. But they actually kind of went hell for leather on this, knew that they had something really special. And even I remember living in Australia, the government was going to fine the drivers 1,700 quid every time they were caught, and Uber just came in and said, don't worry about it, we'll pay the fines. And so they just kept going and they grabbed market share, and now no one can kind of figure out living without them. So the valuation they're looking at it is something in the region of 120 billion, which is crazy. They had revenues of 11.4 billion last year, but lost 2 billion on the bottom line. So really I'm more interested in see how it goes rather than interested as an investment, but that's the one I'm anticipating.
Hefty valuation.
Okay.
Nave is so much more strict than me with the time.
Well, and I don't know if that's a positive or a negative because you're kind of rushing to make your pitches. But look, it is
It's
the
an
name
elevator.
of the game.
And by the way, just to on that point, if Uber floated with a market cap of 120 billion, just to help people understand how big that is, that's 3 times the size of Tesla today.
Yeah.
It's a big business, like that is giant. And not having dived into it yet, because there's nothing to dive into really at the moment, I wouldn't go near $120 billion.
Oh no, and that's the thing. That's what I'm so excited about. Is like no one really knows what's going to happen.
Yeah.
Like a lot of the valuation is kind of this
Yeah.
idea people have of Uber as this
Yeah.
incredible company. But like
Yeah.
when it comes down, when we see all the figures, we'll see what actually happens.
So about 2.5 times. I've just looked up Tesla's market cap is 47 billion.
Yeah.
Save people right in. So rather than threefold, it's 2.5x.
What do you think, James? If you were to
Unsure.
lean
They're
towards
both, from a consumer point of view, they're both companies I really, really like. It's probably worth pointing out that Uber actually doesn't operate here in Ireland at the moment because of legal stuff. But whenever I notice myself over in London, whenever you go over, it's Uber is
You
all
need it.
anyone
Yes,
uses.
yeah,
And
you
it
need
is-
it. Yeah,
It is
yeah.
just, I love
Yeah.
it. I love it.
But
Yeah.
you need Airbnb now as well.
Yeah.
Yes,
If you want to
true.
live your life a certain way,
Yeah,
and
for sure.
have a certain style of holiday.
That's right.
I
yeah.
remember there was a great interview with Scott Galloway, who I talk about way too much on this podcast. It's almost his podcast at this point. But he was talking about Uber and Airbnb and which one he liked more. And he actually said Airbnb should be the more valuable company.
Yeah.
And the reason he said that is like, if we wanted to, we could set up an Uber in Dublin. You know,
Yeah.
all you need is a local network of drivers and a local network of consumers.
Yeah.
But Airbnb, people rarely go to an Airbnb in their own city. So what you need is a global network
Yeah.
of hosts and a global network of consumers. So
Yeah.
they've been able to build that global network. Whereas, you know, we've seen Canada has their own version of Uber,
Yes,
which is
yeah.
the main one. You know, just by having a local group of people driving cars, you can start an Uber. Whereas Airbnb is a lot trickier business.
Absolutely. I mean, we buy businesses based on culture and passionate founders who are doing something for the greater good, and Airbnb is doing that. You know, when you listen to or watch Brian Chesky on YouTube or on Business TV, he is an inspirational guy who's doing it because he completely believes in it. If you look at the cultural story of Uber with, you know, Travis Kalanick, and we won't go there, they're two very different stories, and they're two great businesses, but if you had to pick one over the other, and if passionate founding CEO who is culturally aligned,
I'm glad
with
you
us.
said that, Emma, because it gives me a chance to try and pronounce the Uber's new CEO's name.
Yeah, over to you.
Do you know what? I think that's a good place to wrap.
No, I can do it. I've been practicing.
Okay,
Dara Karashawi.
very good.
Nice.
I didn't think you could do it.
I
I thought
think
you were
so.
prompting
No,
me to...
No. And he's
to
good. I
wrap.
like him.
Great.
Okay,
great.
right, well, we're loitering outside the lift after all today. Time governance, so I think we'll wrap.
Who
That's
are you
it.
picking, Maeve?
Oh, do I get to pick as well?
Yeah,
Yeah.
I picked Airbnb, by the way. I didn't say it.
I thought I was going to just stay kind of impartial on this one. It's the same as last week. I used both. It was
Yeah.
like Eventbrite and... Who was the...
Oh, Teladoc.
Teladoc. Well,
yeah.
sorry, so I own both those stocks. I use both here. I had only used Eventbrite. I'm kind of more interested in Airbnb.
Yeah.
I just want to see what happens next in that story.
And to be honest, that was one I was going to pick, so I'll take
Okay.
that loss
Okay.
in good spirit.
Right, okay, we're going to wrap. That's it from us, and that's it from this week's Stock Club. If you have anything that you want us to discuss next, you can send it to us at pod@mywallstreet.com, and the spelling is pod@mywallst.com. There's plenty of stuff in the app for you to check out. There's the recent expert opinion piece that Rory, James and I discussed the last time we talked. The title is Thinking in Bets, and the theme is about making intelligent decisions. You can listen to the podcast in the app. We're just checking that you know that, so you'll find it in the featured section of the Focus tab. If you like what you hear, we'd really appreciate if you rated, reviewed and shared. And that's about all we've got for this time. So from everyone here, see you in 2 weeks and happy investing.